You ever get that feeling, that sudden cold panic about your retirement, thinking, am I behind? Well, we're about to break down a real-life email exchange between an aspiring investor who felt exactly that and their teacher, whose brutally honest advice, well, it changed everything.
So, it all kicks off with this one sentence. A student takes an investment class, and instead of feeling confident and empowered, they're hit with immediate anxiety. And you know what? I think a lot of us can relate to that feeling, that sudden, gut-wrenching realization that you might be way behind schedule.
So where is all this anxiety coming from? It didn't just pop up out of nowhere. To really get why the teacher's response was so intense, we've got to first understand the person who wrote the email. Let's dig into their situation.
Now, we're not talking about a total beginner who's lost a bunch of money. This is a hardworking professional, someone who's been so focused on their career that they kind of let their personal finances just drift. They'd invested before, but cashed out to buy property. And now they're looking at the calendar, and that deep panic is setting in. That, oh no, am I too late feeling?
So they're panicked, but they're not just sitting on their hands. They've actually come up with a super detailed plan to try and catch up fast. And the whole thing, it hinges on one big, really risky strategy, using debt. Let's take a look at what they cooked up.
All right, let's look at the financial snapshot here. And honestly, on paper, they look pretty solid. They've got assets over 35 million new Taiwan dollars, property, insurance, cash, the works. But, and it's a big but, they're also carrying 11 million in loans. Now, the key to their whole plan, what they see as their secret weapon, is that very first line, that investment property that's totally paid off.
And here's the plan. They're going to borrow $5 million against that paid-off property. Now get this. The interest payments on that loan would be covered by the rent coming in. So in their head, it's like free money, right? Then they'd start small, investing just $5,000 a month into an ETF. And they've got their insurance policy as a backup. I mean, on the surface, it seems pretty clever, well-structured, a slick way to catch up. But then they reveal the fatal flaw. And there it is. The fatal flaw isn't in the spreadsheet. It's in the mindset. The investor just straight up admits their biggest fear. They know deep down that they don't have the psychological strength to handle a massive market crash and stick it out. This one single sentence, man, it changes the entire game.
So after hearing that really honest, vulnerable admission, you might expect some gentle advice, right? Maybe a little encouragement. Nope. What comes back is immediate, and it is unbelievably blunt. The teacher doesn't suggest a few tweaks, it's just a full stop.
Boom. That's the first hit. The teacher takes the student's own words and turns them into an absolute law of investing. Being able to take a punch isn't just a nice-to-have skill. It's the price of admission. If you can't handle the heat, you have no business being in the kitchen.
And the second punch follows right away. This one goes straight for the heart of the student's plan, the leverage. The teacher makes it crystal clear this isn't just a bad idea. For someone with this mindset, it is absolutely forbidden. Don't even go there. The teacher's logic here is just painfully simple. You can always hear him saying, "Are you kidding me? You just told me you'd freak out and sell if you lost your own money. What on earth makes you think you'll be cool and calm when you're losing the bank's money? The fear would be 10 times worse." So putting those two ideas together, a fear of downturns and a plan to borrow, it's not just a bad combo, it's a recipe for absolute disaster. So, why so harsh? Why the absolute no? Because the student fundamentally misunderstood what a real worst-case scenario even looks like. Their imagined disaster just wasn't disastrous enough. See, the student was afraid of an 80% drop. The teacher's point? A true market catastrophe, a real historical crash, could be even worse. We're talking an 85% wipeout. Now that extra 5% might not sound like much, but trust me, when you're already down that far, it's a whole new world of financial and psychological pain. And maybe even more important than how far it falls is how long it stays down. The student worried about holding on for 10 years, the teacher basically confirms, yep, that's realistic. A full recovery could easily take a decade or even longer. Just imagine that, 10 years of watching your portfolio go nowhere, all while you're writing that interest check to the bank every single month. And this really highlights the huge disconnect. The investor thought they were planning for the worst, but their version of the worst wasn't even close to reality. A real market collapse isn't a dip, it's a chasm, way deeper and longer than most people can truly wrap their minds around until they're staring right into it. This brings us to the core idea here, leverage risk. Using borrowed money is like strapping a rocket to your portfolio. Yeah, it can send your gains into orbit, and you'll feel like a genius.
But that rocket works both ways. It also magnifies your losses. When you combine that explosive potential for loss with someone who's already admitted they're afraid of falling, you're basically building a psychological trap that's impossible to escape.
So if the plan to use debt is out, and the teacher is saying even normal investing is off the table for now, what's left? Well, the teacher's final piece of advice reframes the whole problem. The most important investment you can make, it turns out, isn't financial at all.
And this is the ultimate lesson. The teacher's final verdict is simply, you're not ready. Not because your numbers are wrong, but because your knowledge and your mental fortitude just aren't strong enough yet. So the advice isn't to change the plan, it's to get out of the car entirely. The most important preparation you need to do right now isn't financial, it's mental.
This whole exchange leaves us with a really critical question we all have to ask ourselves. Are you investing in stocks, or are you investing in your mindset? Because the lesson here is that being financially ready and being psychologically ready are two completely different things. Before you leverage your assets, you have to first understand your fears. Because when that storm inevitably hits, it's not your financial plan that's going to save you, it's the strength of the mindset you've built to endure it.